For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events, also the best places to put your money if interest rates fall, retirement rules often taken out of context, and then 5 financial blind spots to watch out for entering retirement. My name's Jeff Shade, and as always, I'm just here to ask the questions. But the words of wisdom and solid advice, they come from Jake Floyd of Floyd Financial Group. Good morning, Jake. How you doing today?
I'm doing great, Jeff. Thanks for asking. How about you?
I'm doing great, thank you. Now that we're together again on the radio, talking to fine people here, the last bastion of sanity, Springfield, Missouri. Well, let's start off the show today, Jake, by talking about current events. Last Wednesday, Fed Chair Jerome Powell had his meeting. What did he tell us about inflation and basically about rate cuts?
To be honest, he did about a 45-minute press conference, as he usually does, and basically every question he was asked, he was kind of like, well, we don't know. They said, we've got inflation going one way and unemployment going the other, and those are your two mandates. Which one's more important? Well, I don't know. Like, what do you think about, which one are we more likely to act on in the near future? Well, I don't know. And so he was very non-committal, but he was pretty clear that they were not about to cut interest rates. And so since then, we've had this China deal last weekend. And I think after that, the Fed watch numbers. So there's a group of people that invest and kind of make bets, if you will, over where interest rate policy is headed. And they were thinking that we're going to have a cut in June. Now they're thinking we're going to have a cut in September is the first one. And so some people are speculating we may not have a cut at all. I'm not sure about all that. I would just say that we need to be invested here because this market, as we've seen over the last few weeks, is still very resilient. That doesn't mean that we can't have another pause or have another little bit of downside pressure, but this market really wants to go up. And so once we get a few of these things cleared off our plate, I think we're going to see it do just that.
Has the tension eased at all between Trump and Jerome Powell? I know that they weren't on great terms here maybe a couple of weeks ago, or at least that's what the media said.
I think that Trump really doesn't have that big a problem with Powell. He just has to put pressure on him for his agenda. And I don't think Powell has a big problem with Trump. I think Powell understands what Trump's trying to do. But Powell obviously cannot acquiesce his requests because he's supposed to be an independent agency. So I don't think there's just a whole bunch of ill will there. The media would love to paint that, but I don't think that's true. According to Powell, they have not spoken in a long time. So I don't think that that's a really big point of contention.
Well, I know like last week, a couple of weeks ago, they were talking about, Trump would like to fire Fed Chair Powell, but things seem to have smoothed over a little bit. But again, I think a lot of that is just media hype. Talking with Jake Floyd, Floyd Financial Group, we're talking about current events. Let's talk about inflation a little bit. It has eased somewhat.
Yeah, so inflation matched this month's numbers to last month's numbers pretty much across the board, which means a lot of the numbers are at 4-year lows on inflation. We're not to the 2% target yet, but we're hovering around 2.7, 2.8 year-over-year numbers. And so we've basically won against inflation, in my opinion. There's people that would push back on that, but I don't think inflation is a major concern in the short term here. So I do agree with Trump. I think interest rates should be lower. Interest rates at the current level at 4.25 to 4.50 as far as the rate, 4.25 to 4.5, is a very restrictive rate. So again, I've said before on the show, it's kind of like driving your car around with the emergency brake on. That's how our economy is right now. If we were at like 3, let's say, I think the proper move would be to hold. But if we're basically in a neutral zone on inflation, I think that we should be at neutral rates, but we're not. We're at restrictive rates. And so I think that's kind of the disconnect for a lot of people is like, you have people that bought houses in the 1980s and they're like, hey, this is nothing. Whenever I bought my first house, it was 18% interest or 16% interest or 12% interest. And that's true, but the value of your house, the amount of income that you spent on rent or owning a house was less than half of what people spend today. So it's not quite the same comparison.
Yeah, Randy and I have talked before about buying the first houses, and, Randy was tickled to get 10%. I remember back in the 80s when it was like 18% people were standing in line for that, so we're doing a lot better today. Let's talk about the U.S.-China tariff situation. One day we've got tariffs, and the next day there is a truce. What's going on there?
Yeah, I think that people were surprised to have so much progress. And again, I don't know if I'd call it progress, but I don't think many people were expecting us to have a 90-day pause right after those talks. Both China and the U.S. were pretty non-committal going into that meeting. And while I do think a 90-day pause is a good thing generally for the economies of both countries, I do think that sets us up for a standoff 90 days from now. And I think that we're already seeing some of the countries that we put the 90-day pause on before, 40 days ago or so. Now we're down to 50 days, and we have one of those 18 countries as a deal. We're kicking the can down the road, which the market likes, but that does set up potential for the market to come back to us some if those deals don't all get done in a timely fashion.
Jake, I heard that some Chinese companies had begun to make inroads into setting up here in the United States. And there's one company that's been operating in Ohio, where I come from originally, where they have taken over a GM truck plant and are doing some glass there. Have you heard any more about the possibility of Chinese companies or other companies moving production back to the United States, or actually American companies moving production back to the United States, or Chinese companies moving here to avoid those tariffs?
I would say yes to all those questions. I think a lot of the goal here was to bring those jobs back here. And as long as these people are not illegal immigrants and these people are U.S. citizens, I don't see any problem with that. Even if they're Chinese companies, if they're employing Americans, whether they're Chinese Americans or white Americans or black Americans, it doesn't matter. Bringing those jobs back here, though, is very good for our economy. There's some of those jobs we don't necessarily want to have back. But I think a lot of the ones that we do want to have back are coming back, or at least generating big investments from different countries or different companies. Like Saudi Arabia last Tuesday, I think it was, said that they're going to be investing $600 billion in the U.S. I mean, obviously, those are huge numbers. Some of these countries, that's like a year's GDP for them. So I think there's a lot of people that would argue with Trump's antics, but it is difficult to argue with his results so far, other than maybe the stock market, but I do think that will also come in the not too distant future.
So let's talk about the stock market. How has the stock market reacted to these tariffs and trade wars and what's going on?
Yeah, so toward the beginning of April, there was quite a lot of panic and people were just terrified and everybody's just selling everything indiscriminately. And then since then, once we got that 90-day pause on the first batch of tariffs, the market came back 15% back to the upside or so. I don't know that I'm ready to just declare victory in the market just yet, but it's a pretty good sized bounce. And it's showing that people have some confidence that Trump is going to be able to get these deals done with a minimal amount of fallout. I also think there's some of this market coming up in anticipation of the Tax Cuts and Jobs Act getting made permanent and some of the other tax features that may come out of the White House and Congress in the not too distant future. Optimism around Ukraine and Russia and all that kind of thing too. I mean, there's a lot of good things going. There are still some things that are negative going on too, though, where we're having slowing growth in some of the tech stocks. Some of the companies are a little bit more hesitant to invest money, which slows things down a little bit. Again, I don't think that's a huge cause for concern, but it's not all just positive news 100% of the time. So we just need to be prudent and stick to the plan.
Jake, we talked about manufacturing coming back to the U.S. I was surprised to learn that we get a lot of our pharmaceuticals from China. I understand that President Trump signed an executive order this past week applying most forward nation status to all the drugs sold in the United States.
Yeah, so as it sits right now, the United States basically pays for the cost of R&D for all these different drug companies. So when they're doing their research and they're developing new drugs, a lot of that money comes out of our pocket because our prices are so much higher. There's examples of really extreme numbers like 200 to 1 that we're paying on certain drugs, but the vast majority of it's somewhere between 30 and 80% higher that we pay for drugs than other places do. And so this executive order is saying, hey, you're going to have to basically raise those prices on people around the globe and lower the prices here, because we're tired of being the whipping boy, if you will, for the drug companies, and we're basically subsidizing the rest of the world for drug creation in the world. I think it's generally a good move. The specifics on how all that's going to come to pass, I have absolutely no idea. And hopefully we'll get some more clarity on that in the next little bit. But it's one thing to say it; it's another thing to get it done. But I do think he probably will get it done. I'm just curious to see what the plan is as far as how to actually make that happen. Are we going to cap prices somehow here, or are we going to just simply say, and what he said was basically we're going to pay whatever the lowest price among these favored nations is. So if we're paying $1,000 and Germany's paying $300 and the UK's paying $100, then our price needs to be equal to the UK's. But what will effectively happen is they won't be able to make it on that. So the other parts of the world's drug costs will likely go up. Ours will come down some, but then it'll be a little bit more fair, I guess.
Jake, we talked about a lot of things here in our current events segment. How do you think the average listener should take this information? How should we use it? How should we digest it?
Not every single thing we're talking about on this show is something that you need to be super aware of. When we do these current events, part of it, some of it's just to make sure that people are kind of informed on all the different things that are happening over the last couple of weeks or so. But some of it does have big implications. I mean, obviously, interest rates and that kind of thing not coming down sooner has implications on housing prices, which may influence your decision or somebody you know's decision to either buy a house or not. So when we're talking about these things, a lot of it's relative to the market as well. And so if we have generally a lot of tailwinds and a lot of good things happening in the market, then that could be good for markets. I'm just trying to give people a sense of where things are. Again, I think it's too early to declare victory here, but at the same time, we have recovered the lion's share of where we were back in early April. And so a lot of people are unsure where we are from a day to day. And so I just like to give those updates. But ultimately, having a professional to kind of manage all this for you and not having to do it yourself is kind of what we're about here at Floyd Financial Group. So we set up a plan on the front end. Maybe you're close to retirement or you are retired and we want to draw some income out of there. What is the investment plan? What is the income plan? And we develop that plan and then we stick to it. And you let us worry about what's going on day to day in the market. But as far as the radio program here, though, we like to just talk about things and make sure people stay informed.
Talking with Jake Floyd of Floyd Financial Group, we've been talking about current events. If our conversation resonates with you, if you have questions of Jake about how the market and how the world environment affects you and your investments and your journey towards a confident retirement, give us a call here. We're offering a no-cost, no-obligation casual conversation. It's the Floyd Financial Group Retirement Review. 417-889-7233 is our number. 417-889-7233. As I said, no cost, no obligation. Certainly no judgment. We'll meet you where you are. You can also find out more about us online at FloydFinancialGroup.com. Jake, time for a break. When we come back, we'll be talking about the best places to put your money when interest rates fall when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about the best places to put your money or not put your money if interest rates fall.
And Jake, if Donald Trump influences interest rates to fall, that typically means the Fed is expected to cut rates, which will have a wide-reaching effect on the economy and financial markets. So let's talk a little bit about how falling interest rates impact different types of investments. So as you said, Fed Chair Powell is kicking that can down the road to September. We'll see if interest rates fall then. But when interest rates do fall, how does that affect the stock market?
Yeah, so generally speaking, when interest rates are falling, the stock market is going to the moon. And that's a little bit of an exaggeration, but if we look back at the 2010 to 2022 period or so, when we had very low interest rates or falling interest rates, we were printing money. Anytime you have perpetually low interest rates like that, we have what we call in the industry as the TINA trade. TINA is an acronym for there is no alternative, simply meaning that if you're a saver and you have CDs and savings accounts, you're not making any money. And so people will come to the market that normally don't go to the stock market simply because there's nothing else to make money on. It's generally very, very good for stocks. It's really good for a lot of asset classes, which we're going to talk about on this segment. But I would say stocks are kind of the clear winner. If you look at any period where interest rates are falling, generally speaking, the money supply is growing. Anytime you have the money supply growing, the market tends to be taking off in a very, a very big way. So generally speaking, very good for stocks.
Would you say that there are certain types of stocks or sectors that one should focus on or not?
Yeah, so typically when interest rates are low, you want to be in the riskier segments. So technology, to a lesser extent, REITs, it kind of depends on real estate, commercial versus residential, that kind of thing. But consumer discretionary is usually very good as well. So think Amazon and Tesla and retail clothing and things like that. We want to stay away from high dividend earners or really safe categories when interest rates are low because they're going to get left in the dust and people will be selling those segments to buy the more risky segments in tech and communications. Think the Magnificent Seven, NVIDIA, Tesla, Amazon, Google, Apple, that type of thing. Those types of stocks tend to do very well when interest rates are low.
Jake, how do falling interest rates affect the real estate market?
Yeah, so that's probably number 2 on the list. If you're going to say, hey, what are the best places to put money when interest rates are low? I'd say stocks first. I'd say real estate second. It's probably no secret that real estate prices are up a lot over the last 15 years, but definitely over even the last 6 or 7 years. A lot of real estate prices, especially land prices. There's land that's outside of town an hour or two. A lot of that land has gone up 300%, 400%. Housing is up probably 50% on average over the last 6 years or so. So anytime you have a perpetually low interest rate there, then that means that people can finance their houses at 3 and 4%, which just really drives the prices because people can now buy much more house than they could buy before. And so as interest rates get ready to fall, I think this housing market is very much poised for another big run up if we do get, in fact, lower interest rates.
So lower interest rates certainly mean higher prices of houses. Higher interest rates mean lower prices of houses. It almost comes out to a wash. But anyway, real estate is a place that you might want to put your money and maybe investing in rental properties if cash flow is positive, if interest rates do fall. Let's talk about bonds, long-term treasuries or high-quality corporate bonds.
Yeah, so one more thought on real estate there, Jeff. I would just say that from a cost-to-own standpoint, it's kind of a wash. But for anybody owning real estate or owning, a large house or property, I promise you they can tell you it has not been a wash for them. There's a lot of people that had farms that were worth $500,000 that are now worth $2.5 million, things like that. And so, yes, from a cost-to-own standpoint, it's kind of a wash, but not if you're owning those things during those periods. You can really make out like a bandit. So even though that 300, 400, 500% sounds like a big number, from 2009, the bottom of the market, through earlier this year, the market was up over 900%. Even though the real estate returns have been good, the stock market has been better. All right, now to bonds like you were talking about. So bonds, generally speaking, as interest rates fall, also do pretty well. This is where the traditional wisdom of owning stocks and bonds, when stocks go down, bonds go up. And when bonds go down, stocks go up. And it kind of offsets in your portfolio. That's how we learned for the first 100 years in the market how it works. Since we started artificially lowering interest rates, either through quantitative easing or just putting interest rates lower, all these things have been going up and down in unison in a lot of cases. So if we have falling interest rates, not only are stocks going up, but bonds are also going up too. And if you think about bonds specifically, bonds are kind of like a teeter-totter. So if you draw a teeter-totter on a piece of paper and you say, okay, I have this bond and it's $100 and it's paying me 4% interest. If interest rates fall, then if you draw the teeter-totter where interest rates are going down, that means the price of your bond is now higher, because if they can buy a bond from you at 4%, why would you sell it to them for $100 if all they can go buy now is a 2% bond, right? And the answer is you wouldn't. You would sell yours at a premium because it's worth more, because it pays more. The opposite is also true. If we have interest rates go up rapidly like we did in 2022, then bonds tend to take a big hit, because why would anybody pay you for your 4% bond if they can go buy one that pays 5 or 6? Generally speaking, though, that was a long-winded answer to say that when interest rates are falling, bonds are a good place to be because you do get safety there, you get interest there, but you also can get some appreciation depending on the length of those bonds.
Talking with Jake Floyd, Floyd Financial Group, we are talking about best places to put your money when and if interest rates fall. Again, if our program has resonated with you, this particular conversation, you'd like to talk to Jake or Randy when he's in the office, call this number right now. It's 417-889-7233. Request your Floyd Financial Group retirement review, no cost and no obligation. 417-889-7233. And you can make that call right now if you want. Okay, so falling interest rates, Jake, how do you think that they would affect gold and other precious metals?
Yeah, so gold has had a pretty good run lately. Gold trades off of a couple of different things. Gold trades off of fear, number one. When people are afraid, people tend to default to gold. We've definitely seen that over the last couple of months. Since the market has been starting to feel better, though, gold has come back down some. We'll see kind of what gold's next move is. So it trades off of fear, but it also trades off of inflation. If you have persistently high inflation, gold is a general thing that people like to buy because if the dollar is weakening, then it simply takes more dollars to buy gold. Therefore, the price goes up, if that makes sense. So those two things are really what drive gold. So generally speaking, if you have low interest rates, gold tends to do pretty well as the Fed prints more money because it weakens the dollar and gold goes up. And we've definitely seen that over the last little bit here. What the next move is going to be is hard to say until Trump kind of gets done with what he's doing because it creates a lot of uncertainty. But I think as the wars start to go away, as the tariffs start to go away, I think gold will come back down some simply because that fear premium will be out of gold.
Let's talk about refinancing debt, Jake. Not necessarily a conversation about where to put your money when interest rates fall. But if interest rates do fall, that would have a positive effect on your ability to refinance debt or make it easier for you.
100%. I think this is probably the biggest tailwind when it comes to markets and real estate and just the economy's health overall. For the last 30, 40 years, people have been overspending. And as they overspend, they rake their credit cards. And as they rake their credit cards, they eventually become over-leveraged. The default move for the last 3 decades or so has been we go ahead, we refinance our house because our house is now worth more than it was before. We refinance the house, we pay off the credit card debt, and then we go again. The problem is with interest rates being where they are, the last 3 years, people have not been able to do that. And so people are starting to get a little bit over leveraged. If we were to get interest rates to come down, people would definitely refinance and pay off that debt, which would really give us the latitude to take another leg higher as people spend more money. Now, again, I'm not advocating that we run our credit card debt up and pay it off with our house,
Right.
but that is definitely what happens in this country and around the globe. But this country specifically needs that because people are overspending and eventually they'll get over leveraged if they don't have a way to relieve that pressure.
Jake, what are some of the other investments that we may want to avoid when interest rates eventually do fall?
Yeah, so savings accounts and CDs and money markets tend to be the big losers when it comes to interest rates falling because those with a short memory may not remember, but from 2010 to 2022, you basically got 0.1 on savings accounts and maybe 0.25 on CDs. Now we're in a situation where you can get north of 4 on CDs, at least for now. I would not expect to stay there long term. We will eventually cut some interest rates. You might have a good rest of the year here. But at some point, interest rates will start to come down. And the biggest losers, if you will, and when I say losers, I'm not talking about the people, I'm talking about the investments.
Yeah.
There's nothing wrong with saving, but those are the people that get hurt the worst is the people that are used to investing at the bank, CDs, savings accounts, money markets.
Jake, we talked about this being kicked down the road until at least September when Fed Chair Powell speaks again on the possibility of reducing interest rates. And as we've said many times in the program, we do not have a crystal ball. We cannot foretell the future. But what is your gut feeling about interest rates as we head into this year? I mean, we're already almost in summer, but by the end of the year, do you think we'll eventually see interest rate cuts?
So my gut tells me that as long as the market is doing what it's doing right now, and as long as unemployment remains well behaved, and as long as inflation doesn't just start evaporating and we start getting deflation, I don't think the Fed's going to cut. They have said repeatedly they're going to wait for the data, and unless the data show that they should be cutting, I don't think they're going to be cutting. So I think the only thing really to focus on, in my opinion, as far as the Fed's concerned, is focus on jobless claims and unemployment rate. If unemployment really starts to tick up, the Fed will not hesitate to cut. But short of that, I think it's going to take a lot to get them to cut interest rates. And we saw that earlier in the year, people were projecting 6 or 7 rate cuts this year.
Wow.
Then they were projecting 3. Now they're projecting 2, and the first one being in September now, which it was this next meeting that people were expecting them to cut just last week. So all that to say that the sentiment is shifting. Things are not weakening the way people had said they would under the tariffs with Trump. Now, again, some of that's because the tariffs are paused and all that. But ultimately, we're not really seeing a lot of weakness. We're seeing some weakness and the beginning of weakness, but we're not seeing full-blown people getting laid off and a lot of money saving going on. For the most part, these businesses are still investing and doing their thing there. And so as long as that's the case, the Fed's going to be pretty hesitant to cut.
So it's pretty much going to be status quo through the end of the year. Talking with Jake Floyd, Floyd Financial Group, we've been talking about interest rate cuts and places to put your money. If our conversation interests you and you'd like to get in and sit down and talk with Jake of Floyd Financial Group, we can not only talk about interest rates, but certainly talk about every aspect and every facet of your retirement. If you've got questions, we've got the answers. No cost, no obligation. It's just a casual conversation. To get yours, call 417-889-7233. You can make that call this morning if you want. Leave your name, telephone number. Ashley will be happy to call you back during the week and set up that appointment for you. Again, no cost for this at all and no obligation. 417-889-7233. Make that call right now. You can also find out more about us online at FloydFinancialGroup.com. Jake, we're going to take another break here on Show Me the Money. When we come back, Jake, we'll be talking about the rule of thumb. Many people mistaking that for advice. When our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shade.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about retirement rules, quote unquote, that are often taken out of context.
That's right, Jake. And a lot of people hear these rules of thumb, so to speak. And again, that's one of those idioms. Where does rule of thumb come from? And we'll have to check that out. But anyway, they mistake these rules of thumb for advice when it couldn't be further from the truth. So let's break down a few of these rules of thumb that we hear about all the time. Number one is the 4% rule, or otherwise known as the rule of 25. Now, that just does not apply to everyone. Does it apply to many people at all?
I would say that if you have saved a lot of money or inherited a lot of money and you're wanting to be aggressive at the stock market and things like that, I think the 4% rule can hold some water. But it's a good rule of thumb. I usually shift it to the 5% rule because I deal with retirees' money, generally speaking, people's money that need this money in retirement. And so we're going to have a fair amount of safety in the portfolio. But the primary function of a lot of people's money that I see, not everybody, but probably 70%, is to get them through retirement, to supplement Social Security or any pension they have. We want to take some money out of these funds to get them through retirement, and they need it. And so because of that, we have a certain amount of safety involved, and we can push that 4% a little bit further, maybe to 5%, maybe even 6%, depending on the situation and whether you want to see your money continue to grow, or if you're okay with watching it come down a little bit, knowing that you get a little bit more income. That's one of the primary things we talk about when we're doing planning in here is, how do we turn this pile of money into a paycheck?
All right, so you said the 5% rule, so to speak, or really it's not a rule, but it's a suggestion is what you start with. But then there's this rule of 25 that says you should save 25 times your salary in order to have a successful retirement. Is that always the case with you?
Yeah, so again, that's a good rule of thumb, as we say, but it's definitely not mandatory. A lot of this has to do with when you're going to retire, too. So if you retire at 50, I think the 4% rule might even be too much. Because if you have to live 45 years off your money, we have to make sure we're able to weather any storm that can possibly come at us. And so if you retire at 70 and maybe you're not in the greatest health and we're only having to account for 15 or 20 years worth of income, then we can be a little bit more aggressive with how much money we take out. So I would just say that it is a good rule of thumb but it's certainly not something you should just take to the bank and say, if I only take 4%, I'm fine, because it's more complicated than that. When you're doing your calculation, let's say you're 5 years out from retirement and you're doing your calculations, look at 4%, look at 5%, and you can kind of gauge, okay, I have $500,000. That means I can get $25,000 a year, or roughly a little bit less than $2,100 a month to supplement my income from Social Security, from my pension. And so you can use that to kind of do some of the calculations. Now, again, that's what I do here for a living. So feel free to come see me and I can take all the math out of it for you and I can kind of show you how it works. But if you're doing these calculations on your own, and maybe you're even 20 years out from retirement, you're trying to reverse engineer your plan, 4%, 5%, those are good rules of thumb to kind of do your calculations ahead of time.
So rule of thumb, I think it means that these are suggestions, but they're not hard and fast rules. As you said, it could be 5%, it could be 3%. Longevity figures into this too. If you don't have longevity, it could be 10%. It just depends. 417-889-7233 is Jake's number if you'd like to come in and talk to him about the 4% rule. Next rule that we hear about is the rule of 100. What is the rule of 100, Jake?
So the rule of 100 dates back a long time, but basically it says that take your age and subtract it from 100, and then that's how much money you should have at risk in your portfolio. So if you are 65, then that means you should only have 35% of your money at risk. Now, I find this to be a little bit too conservative most of the time. If I were going to alter this rule, I would say take your age minus 100 and then add back 10, and then you're probably a little bit closer. Or you could say take your age from 110 instead of 100. So, because if you're too conservative, you're just going to miss out on return, and you don't need to be just super, super safe when you're 65. Now, when you're getting up into your 80s and things like that, and you're spending some of your money, maybe it's appropriate to have a little bit more safe, especially depending on your goals with your beneficiaries and where you're going to send your money. But I think that 35% at risk for a 65-year-old is a little bit too conservative in a lot of cases, not in every case. And some people are just risk averse and they say, hey, I don't want to ever lose $1. And we can work with that. There's different things we can do, tools we can use to make sure you never lose $1. But for the most part, a lot of times at 65, we'll have a more of a half and half type of approach. If somebody comes and says, Jake, what do you think? With your experience over retirement, we're going to take a responsible amount of money out of here. At 60, 65, we're probably more like half and half, not 35% at risk, 65% safe.
So again, it's one of those it depends rules. And I think at one time, maybe these rules were more hard and fast. But considering today's environment, and certainly people are individuals, that these could be subject to change. Let's talk about the rule of 72. What is the rule of 72?
Yeah, so the rule of 72 is kind of a quick math way of saying, hey, take your rate of return and divide it into 72. And that tells you how long it'll take you for your money to double. So if you're getting a 7.2% return, then that means your money should double every 10 years. If you have a 4% return, then your money's going to double every 17 or 18 years. And so it's a little bit of a cheat sheet to say, okay, how much money do I need to make to double my money? Or you can work it back the other way and say, hey, I want to double my money every 7 years. How much return does that take to do that? That is a fairly hard and fast rule, but it totally ignores your risk tolerance, your situation in life, whether you should be taking that much risk. When we're looking at risk, we're talking about risk tolerance, which is how much risk you're comfortable taking. But then there's also risk capacity, meaning how much risk can you afford to take based on your situation, based on how much money you need off of your investments. And so there's a lot of factors to consider there, but that is a good kind of a cheat sheet, if you will, to think about how long it takes your money to double. So if you have a 40-year time horizon, right, and you want to double it every 10 years, let's say you start with 100,000, then it becomes 200, 400, 800, then you can map all that out using the rule of 72 without getting too complicated with the calculations or, having to have a big spreadsheet run to figure it out.
Talking about rules of thumb with Jake Floyd, Floyd Financial Group. Again, 417-889-7233 is our telephone number. If you'd like to come in and sit down and talk with Jake about these rules. These are kind of fun. I like that. The rule of 72, 7.2% return. Your money is doubled every 10 years. Okay, let's go on to the next one. 3 to 6 months of emergency fund rule. Is that necessarily a hard and fast rule? I've heard people say, well, you got to have a year. You got to have 2 years. Some people say 5 years. Is it advisable to have only 3 to 6 months of money set aside in case of emergency?
Yeah, I would say if you're going to retire and you've done a good job saving, I would say having a year's worth of what you're taking out of your investments on the side is probably a better way to look at it. That being said, I have people that it drives them crazy if they have an extra 5,000 in their savings account and they want all their money invested all the time. That is not something I would necessarily advise, but this is probably the biggest personal preference one of all these different rules of thumb. I have people that have, let's say, maybe $1 million invested, but they're not comfortable unless they have 400,000 in the bank. That's a little bit excessive for the average person, but ultimately it's about what makes you sleep at night. And if it's going to stress you out to have less than 100,000, then maybe 100,000 is the right number. But we want to make sure that money is working for you somehow, especially in today's world where CDs are paying and savings accounts are paying. I have a lot of people that have big chunks of money when they come in to see me like that, that's earning 0.1% in a savings account. So we want to make sure that that money is producing. If you got $100,000 on a savings account and it's paying you $100 a year or something like that, it should be paying you more like, $300 a month or maybe even more depending on the situation. So we don't want too much lazy, dusty money, but at the same time, everybody has their own comfort level with exactly how many dollars need to be there. I do think 3 months emergency fund is probably a little light. 6 months feels better. A year feels better. More than that, we want to make sure that the money's at least invested somewhere where it's going to make some money for you. But again, my goal when people come in to see me is not to just totally upset their apple cart. If you've been used to having $100,000 at your fingertips for a long time, I'm not going to try to change that. That's really a personal preference one.
Okay, so we can settle on 6 months to a year as far as emergency savings go. There's this 80% replacement rule, Jake. What is that?
Yeah, so the 80% rule is saying that if you made $100,000, let's say, before retirement, that you only need 80% of that income when you retire, or $80,000 a year. This is a very big, broad blanket claim that I would say holds water almost 0% of the time. It can be all over the board. I mean, what if you're funding 25% of your income into a retirement plan, right? And guess what? When you retire, you're not going to be doing that anymore. Well, that's already down to 75 right there. We haven't considered less taxes, no Social Security taxation, no FICA, which is Medicare, Medicaid, workers' comp, insurance deductions, all those things. When we're thinking about how many dollars you need in retirement, a better way to go about it is let's take your take-home paycheck and let's add back in the cost of insurance and some money for taxes. And that's a better litmus test of what you really need in retirement versus this blanket 80% rule. A lot of it is also going to have to do with what you like to spend time on. How much does it cost to do the things that you want to do? Are you into skydiving? Are you into traveling the world? Are you into sitting on your porch? And I have a lot of people that's what they really want to do is to not have to do anything. Mm-hmm. They still work around their property and they do different things, and maybe some of them work part-time. But the goal a lot of people have in retirement is just the knowledge that they don't have to get up and go to that job they've been going to for 40 years.
Right.
And I think that part people have in common, but understanding who you are and what's important to you is probably more important than this 80% rule, meaning if your goal is to stop working and then go do everything you've ever wanted to do, that's going to cost more money than you're making now, probably not less. Some people, they come out and they say, hey, I want to go nuts for 5 years after I retire because I know that's when my health's going to be good and I want to go travel and I want to go do all these things. And then after that, I'm okay to take a big pay cut. But that first 5 years, I want to spend a bunch of money and I want to go do a lot of things. And we can incorporate that into a plan and I can show you what that looks like. But a lot of people, they just want to know that they're never going to have to go be a greeter at Walmart. Right. And that's a different situation than, hey, I want to go take 4 cruises a year and I want to go fishing in Alaska or whatever it is, which all those things cost pretty big dollars. So us understanding what's important to you is probably the biggest thing we do in our first meetings when you come in. We want to understand you and understand what's important to you so that we can set up the plan to accommodate those things.
Let's wrap up this conversation about rules of thumb. The 3-fund rule. What is that?
Yeah, the 3-fund rule. I definitely would not agree with this one at all. But basically, the 3-fund rule says you can replace your entire portfolio with 3 ETFs or mutual funds, which is a U.S. stocks ETF, an international stocks ETF, and a bond ETF. And while I think you might be able to get away with that, personally, I think if you really do your research into international stocks, any period longer than about 2 years, you're going to find that international stocks underperform with more risk. So I'm not really big on international investing at all. There's a handful of nations I would invest in. I think Argentina looks a little bit interesting here, given that Javier Milei down there is cracking skulls and taking names. I think that by and large, we need a little bit more thought put into these approaches, because let's assume for a minute that you had your money in this type of setup in 2008, right? You're likely going to be down 30, 40% in your portfolio, maybe even more, depending on which funds you're in. And I don't think that in retirement we should ever be suffering a 30 or 40% loss. That's a huge loss as far as your total nest egg. We need to have better protection in place, better income generation that's not dependent on interest rates in the moment. There's a lot of potential issues that I see with this 3-fund rule.
So I think really the takeaway from our conversation this morning, Jake, about rules of thumb is that you should build a plan around what you want, not a rule of thumb and not a cliche. You want to sit down with Jake, talk about these rules of thumb, and maybe work out a plan specifically designed for you? Give us a call here at Floyd Financial Group at 417-889-7233. Set up an appointment with Jake and or Randy when he's in the office. We'll be happy to meet you where you are, no cost, no obligation. 417-889-7233. Of course, online at FloydFinancialGroup.com. Jake, let's take another break. When we come back, we'll wrap it all up for today. We'll talk about 5 common financial blind spots that people often miss when heading into retirement, when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about some common financial blind spots people often miss heading into retirement.
And Jake, a lot of people miss these blind spots because they are like, on your car. You look over there, and unless there's some sort of an alert, you could miss these blind spots and have an accident. We don't want you to have an accident with your retirement plan. So let's talk about some of these blind spots. I think the biggest one is underestimating healthcare costs. And I think that a lot of people think, well, I've got Medicare. That's going to take care of everything I possibly could need.
I think in today's world, there's a lot more people today that know what healthcare is going to cost them, especially long-term care later in life. I would shift this one to say that maybe it's that they don't have a plan, or they've not thought about how they're going to pay for this or when they're going to pay for this. And so for most people, they don't instantly go from staying at home to instantly needing a nursing home. Now, there's a handful of people that do. But for the most part, it's a graduating scale, right? We start to have a little bit of trouble. And maybe that trouble can be solved by, having 4 hours a day worth of in-home care. Make sure you get your meds and get a square meal and all that kind of thing. And then maybe later you need a little more care. And then maybe we need assisted living. And then finally a nursing home. And so having a conversation about that and how that would go. What money would you spend first to start that process? Do you have long-term care insurance? If you don't, that's fine. Is there a pile of money that we would spend first that we want to set aside in some kind of an asset-based care plan that would multiply that money for healthcare costs? So there's a lot of ways to tackle this, but I would say being honest with ourselves about 70% of the people alive today are going to need some sort of long-term care. And I think that being honest about how that's going to happen, when that's going to happen, and really taking the dive instead of kind of burying our head in the sand going, this isn't going to happen to me, or my kids will never let me go to a nursing home. They may or may not have a choice at some point. Even if they're good kids and they want to take care of you, they may not be able to take care of you at some point. I've seen people taking care of their parents that put themselves in a nursing home right next to them because it can be very mentally and physically taxing. Having an honest conversation with yourself or with a professional about how are we going to go about spending this money? Which money do we spend first? And should we set aside a little bit of money to leverage against care costs looking forward?
Yeah, and that's something that certainly we have a lot of discussions about here at Floyd Financial Group is how to pay for long-term care. I know that Randy's done the seminar 4 Ways to Pay. And on the subject of Medicare, especially it does not cover dental, vision, hearing aids, and of course, long-term care. So underestimating healthcare expenses is our first common financial blind spot. Next one has to do with inflation and purchasing power erosion. Jake?
Yeah, so people, when they come in asking about inflation, most of the people really didn't talk a lot about that prior to the last 5 or 6 years because inflation was kind of not a big issue to talk about. Inflation over the last, 60 years, even including the inflation we've just had, is like 2.3 or 2.4%. And prior to that, it was around 2 or maybe even slightly under 2. And so inflation was not a real big deal on people's plate before. But now we've had all this inflation in the last 5 years, and people are very keen on trying to make sure that they're ahead of inflation. Now, there's no accounting for 7 or 8 or 10% inflation a year. We just need to kind of hope that doesn't happen, and I don't think it's going to happen, but there's no way to get 10% more income a year for 30 years in retirement. You'd end up with 6 or 8 times what you're making now, and there's just no feasible way to do that unless you're just a trust fund baby. We want to make sure that we leave room as your retirement progresses to take more income as time goes on. We don't want to take every penny of income that you can possibly take day one because it's hard to give you a raise later. We want to have that balance growing at the early days of retirement so that you can take a little bit more and take a little bit more and take a little bit more. But purchasing power erosion is a real thing. And if you look back over the last 30 years, $1 certainly is not what it used to be. 100,000 is definitely not what it used to be.
Oh, no.
And these are definitely important considerations. And a plan that just totally doesn't think at all about inflation is not a real good plan. So when we're talking about how that's going to work out, usually we set up income plans like we were talking about earlier in the program, the 4% rule. Part of the reason I don't use the 6 or 7% rule is because the 5% rule, let's say, leaves room for you to get raises later in retirement, unless we have super extreme market circumstances. 99% of the time, we're going to have room to take more income as time goes forward.
Talking with Jake Floyd of Floyd Financial Group, when we're talking about common financial blind spots heading into retirement. We talked about underestimating healthcare costs, also inflation and purchasing power erosion. Let's talk about poor tax planning. Boy, there's another one that can really get you.
So tax planning sounds like this big official thing, but really what we're talking about is let's have a plan on how much we're going to pay for taxes in retirement. But let's also have a plan that if we have purchases that you want to make, rather than just taking a bunch of IRA or 401k money and paying off the house at $400,000, costing you $600,000, maybe there's a better way to go about that. And so if people will allow me to, I like to be involved on the front end on these things so that I can maybe help you avoid some mistakes that I've seen other people make in the past. One of the purposes I serve here is when my clients come in to see me, they say, hey, I'm thinking about buying a new truck. What's the best way to go about that? Well, it depends on the interest rate environment. It depends on your personal savings, what types of money you have. Do you have IRA money, Roth money, non-qualified money? And so I can help weigh in on those things to try to keep the tax man at bay as best as possible. Now, all that being said, with a little bit of luck here, we may be in for a couple of really big tax windfalls in the Trump administration. I get asked quite a bit about tax on Social Security and whether or not I think that they're going to be able to negate the taxes on Social Security. I would say there's probably a 50 or 60% chance at this point that we do get that done, and Social Security would be federally tax exempt. Now, that's certainly not a promise. I'm not a soothsayer. I don't know that for sure, but I do think it certainly puts the Democrats in a very precarious position, because if they vote with Trump on that issue, obviously they're going to get criticized for that. But if they vote against their constituency, most of which would benefit from no tax on Social Security or no tax on $150,000 and less in income, that's going to put them in a very interesting position in 2026 for re-election. So they may acquiesce Trump's request on this simply because they want to be able to get reelected in 26 and not just lose every election by a landslide. So that could also come into tax planning. So I have a lot of people right now that have certain things on their plate that they want to take care of, either paying off a house or making a purchase. And I'm like, hey, if you're ready to do it, go ahead and do it. But if you can wait 2 or 3, 4 months, we might know a lot more about what the tax plan is moving forward. And so just having somebody to bounce these ideas off of can be really beneficial to you in retirement.
If you have been subject to believing these financial blind spots, again, call Jake at Floyd Financial Group. Sit down and discuss these with him. 417-889-7233 is our telephone number. Last financial blind spot I want to discuss today, Jake, is overestimating investment income. a lot of people, at least that I've run into, I mean, they think they're going to get 10, 12%. Not always the case.
Yeah, and I think that this comes back to, if you're worried about running out of money, you probably won't. If you're not concerned about running out of money, you probably have unreasonable expectations. At least that's been my experience over the years. Either that or you just saved a huge amount of money and maybe you're in great shape. But those people are few and far between. Most of the people that I see need their money to live on. I would agree with that, Jeff. We do see people that come in and, they've got $700,000 and they're pulling $6,000 a month off of it. And I'm like, this is not, you're going to run out of money if you keep doing this. So keeping those numbers, again, the 4, 5, 6% rule is definitely not the same as the 10 or 12% rule.
Right.
And I do think that in our area, there's more grounded people, I think, than there are in a lot of other areas, meaning people understand that 5% or so is a reasonable number. But I think it has more value to people here to not spend all their money and maybe leave a legacy to their kids than it does in some other areas of the country too. And so people are very cognizant and say, hey, if I'm making 5% and I'm taking 5%, then I get to pass this money to my kids. And that's a little bit of an oversimplification, but that's pretty well accurate, right? And so I think people in this area may have given that a little more thought than some other areas. So I find that most people are pretty reasonable about it, but I do get people that come in and they're like, I've had people they have 500,000, they want to take 100,000 a year, and they're like, that'll be fine, right? I'm like, that will not be fine. And so sometimes I have to be the bearer of bad news.
Yeah.
But again, that's what I'm here for. Sometimes I'm here to give the good news. Sometimes I'm here to give the bad news. Sometimes people come in and say, can I retire? And I get to say, you can't afford to keep working.
Right.
And that's a fun conversation to have. Other times I have people come in and they're spending too much money. I have to say, if you keep doing this, you're going to run out of money. The market has been kind to us over the last decade or so. We may have gotten away with some things we might not have otherwise been able to get away with, and we need to curb that spending. And that's not a fun conversation for me to have, but I will have it anyway because I care enough about my people to make sure that they don't run out of money. So if you're curious about these things, if you're curious about what you should be taking, if you're curious about what your retirement income would look like, come in and see me. I promise I'll treat you right. And again, if there's things I can help with, I'll try to help. And if there's not, I will not try to stick my nose in where it doesn't belong, and we'll have a new friend.
That's right. And I'll share with you and our audience, Jake, I could retire today. I couldn't buy anything, but I could retire today if I wanted to. So if you're worried about retirement, these are some of the blind spots that you may have believed. And I'm glad we had this conversation, Jake, because so many people do believe these things. But I'll leave it on this. As Jake said, if you would like to come in and talk to Jake about these blind spots, or basically anything that has to do with your journey towards a confident retirement, give us a call here at Floyd Financial Group. Our phone lines and our door is always open for our neighbors here. 417-889-7233 is our telephone number. Now, you can make the call right now if you want. Leave your name, telephone number, and of course, Ashley will give you a call back, and she will set up a time for you to talk to Jake or Randy when he's in the office at no cost and no obligation whatsoever, and certainly no judgment. We're all the same here. We'll treat you like family. We'll treat you like the friends that you are. 417-889-7233. You can also find out more about us online at FloydFinancialGroup.com. Jake, we just get started and we run out of time. So I want to thank you for your time, Jake. But most importantly, I want to thank our fine audience here in the last bastion of Saturday, Springfield, Missouri. So for Jake Floyd, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.